awaiting the 10:30 a.m. Eastern Time press conference from the Bank of Canada. The central bank holding interest rates steady, the core rate at 2.75%. We're joined by Ed Devlin, founder of Devlin Capital, senior fellow at the C.D. Howe Institute, and Warren Lovely, chief rate strategist and managing director at National Bank Financial. Thanks very much, guys, as ever. Ed, can I start with you? People expected a so-called dovish hold from the Bank of Canada, but it wasn't completely bland. I mean, they didn't seem to be sort of holding the door open, wide open to interest rate cuts.
Yeah, I would probably say it's a bit more neutral than dovish to be, but you know, it's somewhere between neutral and dovish. And put it this way, if they didn't go last time when the markets were kind of pricing 50-50, a rate cut, there was nothing that really evolved since then that would make them, you know, change their stance. And, you know, especially when the market was only pricing 20% chance of a rate cut today. So, you know, they did kind of what you'd expect them to do. And the statement was, yeah, fairly bland, as you put it.
Warren, Tiff Macklem saying the economy is softer, but not significantly weaker.
Right. So, I mean, from our perspective, and I think what the bank's kind of flagging here is that there's mixed signals everywhere you look. And I guess they're using that to justify holding policy rates here. I mean, look at, you're talking about the GDP outlook. We saw some growth in the first quarter, but we know there's some weakness ahead on inflation. Headline inflation seems to be controlled, but core inflation's hot. The labor market earlier had been healthy. Now it looks weak. The housing market had been weak. Now maybe, as you're pointing out, maybe showing a little bit of signs of life in May. So very much mixed signals. And for a central bank that's told us they can't be forward-looking here, you know, they're using it to justify a second consecutive hold. But I don't think they're done here.
What does that mean when they say we can't be forward-looking? Isn't that their job?
Well, it is their job. So I'm not saying they're not doing their job, but I think what they're really trying to say is that, look, this is extraordinary uncertainty. And again, I mean, you just touched on the renewed or increased steel and aluminum tariffs. We know that the geopolitical backdrop, the tariff backdrop, is ever shifting, almost hour to hour, day to day. So given that uncertainty and the sheer importance of trade and tariffs on the Canadian outlook, they're using that as a rationale to really just minimize how forward they look and react to what they have in hand.
But are they dithering, Ed? Do you think they should be cutting now with significant signs of weakness in the labour market, for example?
Yes. So I think the answer to that is yes. Well, their models can't be forward-looking because their models don't incorporate all the things Warren just talked about. So I understand, I can appreciate that. But let's just take a look at big picture, kind of where we are, right? So, you know, they think they're neutral at 275. You know, I think the neutral rate's lower. So they're probably more restrictive than they think they're going to be. You know, if you think of the economy, what's the balance of the risks? Is it to the upside or to the downside? It's clearly to the downside, right? And then the third risk that I've been harping on, and you've allowed me to, so thank you, over many things, is, you know, I think there's still non-insignificant risk that we get back to zero. And that is when
zero interest rates.
Yeah, and then not this year, but, you know, on this cycle. And that is when nasty things happen. And so,
asset bubbles and
all kinds of the things that we've already experienced the last time we were down there. So we want to avoid that at all costs. So if you think of there's an outcome you want to avoid at all costs, the balance of risks in the economy is to the downside, and you might be a little more restrictive than you think you are, I would say, you know, when you can, get going. So, you know, it's not a national emergency, but if it was me, I would try to park myself up. You know, the bank should park itself up between 1.5% to 2% of the policy rate before then kind of looking around and taking the pause. Because again, these things are going to hit hard. We have no idea. All we know is there's definitely uncertainty and it's doing damage. We just don't know what the damage is. And so better to err on being a little bit more accommodative and easy in your monetary policy. If you're wrong, you can always bring rates back up somewhere down the road, because you don't want to be wrong and wish you had cut earlier and end up at that zero rate. So that is kind of the framework I have.
I see. So you think they should cut now in Canada to avoid the necessity of going to free money?
Basically, take the insurance policy out now. You know, don't wait until the house is burning down. So, you know, take the insurance policy out now, and then if it's not required, you can always adjust later.
But do you think the Fed and Europe will, there's a risk they move towards zero interest rates?
So it's a risk for everyone, but I think it's less for the Fed right now. And maybe a bit for Europe. You know, you can argue there's a geopolitical element to Europe that's a little harder to quantify. But it's definitely a risk period. The Fed right now is in a different spot. So, you know, when in doubt, the Bank of Canada should be cutting, right? Given we're a small, open economy attached to this large economy that's doing some pretty strange things to us. The Fed's got a different issue going on. They've got massive deficits, right? And they've got, a much more closed economy. So, and I think that if I was the Fed, when in doubt, don't cut. So Bank of Canada, when in doubt, cut. Fed, when in doubt, don't cut, because they're really gyrating between, an inflationary environment, an area where we could have the triple B bill go through, the big, beautiful bill, which might be the triple B might be the credit rating of treasuries when they're done with this thing. And so massive supply and long yields much higher. And the bond market's grappling with, or we're heading into more of a slow economy recession, and the Fed's behind the curve, and the long yields are dropping. And so it's very schizophrenic, for lack of a better term, in the U.S. market. And it's going to be a great market at some point, but until we have a more clear sign on the fiscal in particular, and in trade as well, I'm a little more cautious on U.S. rates than I have been before.
Warren, do you think there's a risk? I mean, there's always a risk of everything. I know everything's possible, but is there a real risk the Bank of Canada could be forced to go to zero interest rates?
Well, look, I think Ed's making a number of good points, and I totally agree with the idea that, when in doubt, you should maybe be taking out some insurance here, given what the Canadian economy is highly interest rate sensitive. So a little bit of marginal, if you are questioning the health of the economy, you see some pressures and some weakness in the outlook, which we certainly do, then a little bit of marginal interest rate relief would actually do something, get you something. And I think, at the same time, we want to give the Bank of Canada a little bit of credit here for moving more aggressively than a lot of other central banks. So it's not like they haven't been cutting. They have. And I understand that the outlook is uncertain, but if they could get back to being forward-looking, then I totally agree with that. They should be providing additional interest rate relief. I'm not sure we're going to zero, but I can tell you from our perspective, I think they'll be cutting again as early as July, maybe again in September, maybe even again in October. Maybe we're at that 2% rate, the top end of the range that Ed is talking about, by the fall. And that's probably appropriate given the risks to the Canadian economy, the weakness we're seeing in the labor market, what we think will still be a lot of uncertainty as it relates to the trade situation. And then the last thing I think the Bank of Canada is going to need to start to think about and calibrate their expectations on, and we'll get some clarity on this as we go forward, is what our government's doing here, fiscal policy. Ed talked a lot about the U.S. fiscal situation. We're not obviously on anything like a similar path in Canada. We're being more responsible relative to the U.S. That's a pretty low bar, I guess. But we will see some marginal stimulus from the Carney government in Ottawa and from some provinces. And we want to be able to factor that into our thinking. But that's probably not really going to save us here. So I think you're going to need that fiscal stimulus, a little bit of extra interest rate relief, and that's probably how you start to resuscitate the Canadian economy.
And let me just be clear. I don't think they're definitely going there. I just think that there's a probability that's pretty meaningful to get to zero.
Yes.
And that the outcome is particularly nasty. So when you have a particularly nasty outcome and it's something of a meaningful probability, you really want to avoid it. It's the old, what we saw during the financial crisis, all the central banks went into what they called risk management mode. And I think we should be in risk management mode, even because you use risk management mode when you don't have forecasts.
Right, and 0% rates would be such an undesirable outcome. They should work to avoid that.
Exactly.
Why is America's deficit so bad? Is it just military spending and tax cuts under Republican governments?
Yeah, I mean, if you look at the U.S. relative to the rest of the world, and you look at tax revenue, they're like, I think it's ballpark 10 points below us in Canada. I mean, they're a smaller government, more center-right kind of country, but the problem is they keep spending. So if you think about it, they're in the 6 to 7% GDP. I kind of agree with Ray Dalio. They're at a point where they could really start to spin here,
where
right?
Their deficit
to GDP, right?
And that's before factoring in, sorry, I dished the jump in, that's before factoring in additional personal income tax cuts. But I think to come back to the point, Andrew, in terms of how did the U.S. get here? Let's be clear. The U.S. was running deficits even when they were under prior administrations, when the economy was healthy. We've been running structural deficits in the United States since time immemorial. And for a while, that didn't necessarily contribute to massive debt accumulation. But we've hit this sort of threshold. We've transitioned to a new environment now where you're starting to see the interest bill just accumulating. The budget is eating itself. And you're on now a pretty perilous slope for the U.S. debt outlook. And that's, I think, what Ed is picking up here. And we're at a stage now where investors are finding it harder to ignore. So that great American privilege that prior governments, presidents maybe benefited from might not be as prevalent here.
Right. And it's basically unprecedented in peacetime, right? So, yes, there should be a massive fiscal expansion we saw around the world during the pandemic when we locked everything down. But we're not there. They're now contemplating adding, trillions more to their deficit when the economy's still growing.
When the unemployment rate's barely above 4%.
Exactly. When do you pay it down? If not now, when?
Yeah.
Right. And so this is what got a lot of people concerned, including ourselves. It's clearly going to be steeper yield curves. It was clearly going to happen. And to Warren's point, when you have 4% and 5% interest rates times a massive debt stock, interest is, I think, just below defense spending in terms of the largest line item in the U.S.
We're going to have to take a break. We'll be right back with Ed Devlin, founder of Devlin Capital, and Warren Lovely, chief rate strategist and managing director at National Bank Financial.